Welcome to our guide on the 5 essential rules for successful stock investing. Whether you're new to the market or looking to refine your approach, understanding these core principles can make a significant difference in your investment journey. In this video, we'll break down each rule, explain why it matters, and share practical tips to help you apply them. Let's start by setting the stage. Investing in stocks isn't just about picking winners, it's about building a strategy that stands the test of time. Ready to learn the secrets to smart investing? Let's dive in. First rule of successful stock investing is to always do your research. Before buying any stock, take the time to understand the company, its business model, and the industry it operates in. Look at financial statements, recent news, and analyst reports. This groundwork helps you make informed decisions rather than relying on tips or rumors. Remember, knowledge is power in the stock market. By thoroughly researching your investments, you reduce the risk of unpleasant surprises and increase your chances of long-term success. Diversification is a cornerstone of smart investing. By spreading your investments across different sectors, industries, and even asset classes, you protect yourself from the risk of any single investment performing poorly. Think of it as not putting all your eggs in one basket. If one stock drops in value, others in your portfolio may offset the loss. Diversification helps smooth out returns over time and can provide more stability, especially during market volatility. Successful investors know that the stock market rewards patience. Instead of chasing quick profits, focus on building wealth over the long term. Markets can be unpredictable in the short run, but historically they trend upward over time. By holding on to quality investments and resisting the urge to react to every market swing, you give your portfolio the best chance to grow. Remember, time in the market beats timing the market. Emotions can be a major obstacle to successful investing. Fear and greed often drive investors to make impulsive decisions, like selling during a market dip or buying into a hot trend. The best investors stay calm and stick to their strategy even when markets get turbulent. By managing your emotions and avoiding knee-jerk reactions, you can make more rational decisions and stay on track toward your financial goals. Final rule is to regularly monitor your investments and make adjustments as needed. The market and your personal circumstances can change over time. Review your portfolio's performance, rebalance if necessary, and stay informed about the companies you've invested in. This proactive approach ensures your investments continue to align with your goals and risk tolerance, helping you stay on the path to success. Every investment carries some level of risk, and understanding this is crucial. Risk can come from market fluctuations, economic changes, or company-specific events. By recognizing the types of risks you face, you can make better decisions about how much to invest and where to allocate your funds. Remember, higher returns often come with higher risks, so always balance your desire for gains with your ability to handle potential losses. Before you start investing, it's important to set clear financial goals. Are you saving for retirement, a home, or your child's education? Your goals will influence your investment choices, risk tolerance, and time horizon. By defining what you want to achieve, you can create a plan that guides your decisions and keeps you motivated, even when the market gets tough. A solid investment strategy is your roadmap to success. This means deciding how much to invest, what types of stocks to buy, and when to review your portfolio. Your strategy should reflect your goals, risk tolerance, and time frame. Sticking to a well-thought-out plan helps you avoid emotional decisions and stay focused on your long-term objectives. Compounding is one of the most powerful forces in investing. When your investments earn returns and those returns start earning returns themselves, your wealth can grow exponentially over time. The earlier you start investing, the more you can benefit from compounding. This is why thinking long-term and reinvesting your earnings can make such a big difference. Many investors fall into common traps such as chasing hot stocks, ignoring fees, or failing to diversify. Being aware of these mistakes can help you avoid them. Take your time, stick to your plan, and remember that slow and steady often wins the race. Learning from others' errors is a smart way to improve your own investing journey. Technology has made investing more accessible than ever. Online platforms, apps, and tools can help you research stocks, track your portfolio, and even automate your investments. However, it's important to use technology wisely. Don't let flashy apps or constant notifications distract you from your strategy. Use these tools to support your plan, not replace it. Experience is a valuable teacher in the world of investing. Every investor makes mistakes, but the key is to learn from them and improve over time. Keep a record of your decisions and review what worked and what didn't. This habit will help you refine your strategy and become a more confident, successful investor. The financial world is always changing, so it's important to stay informed. Follow market news, read financial reports, and keep up with economic trends. This knowledge will help you make better decisions and spot opportunities or risks early. Remember, successful investing is an ongoing learning process. Investment fees and costs can eat into your returns over time. Always be aware of the fees associated with buying, selling, and holding investments. Compare different platforms and products to find the most cost-effective options. Keeping your costs low is a simple but effective way to boost your long-term returns. Patience is a virtue in investing. Markets will have ups and downs, but reacting to every fluctuation can hurt your returns. By staying patient and sticking to your plan, you give your investments the time they need to grow. Remember, wealth is built over years, not days. Sometimes, it's helpful to consult with a financial advisor, especially if you're unsure about your investment choices. A professional can help you clarify your goals, assess your risk tolerance, and build a personalized strategy. Just make sure to choose someone with the right credentials and a clear fee structure. Regularly reviewing your investment progress is essential. Set aside time every few months to check your portfolio's performance and see if you're on track to meet your goals. If things aren't going as planned, don't be afraid to make adjustments. Staying proactive helps you stay in control of your financial future. Investing is a journey, and it's important to celebrate your progress along the way. Whether it's reaching a savings milestone or seeing your portfolio grow, acknowledging these achievements can keep you motivated. Remember, every step forward brings you closer to your financial goals. Discipline is key to long-term investing success. This means sticking to your plan even when it's tempting to stray. Markets will test your resolve, but by staying disciplined, you can avoid costly mistakes and keep moving toward your goals. Remember, consistency beats intensity in the world of investing. Wrap up: successful stock investing isn't about luck or secret formulas. It's about following proven rules, staying informed, and being patient and disciplined. By applying the 5 rules we've discussed, doing your research, diversifying, thinking long-term, managing emotions, and monitoring your portfolio, you'll be well on your way to achieving your financial goals. Remember, the journey is just as important as the destination. Happy investing.